Hello friends, I welcome you in this session number 5 of the national income. So till now we have covered some of the basic terms like factors of production, economic agents, economic territory, resident versus citizen of India, right? And we have discussed the circular flow of income, 2-sector economy, 3-sector economy, 4-sector economy. We have discussed the expenditure method, and we have discussed the output or value added methods. Now we are going to discuss the third method of calculation of national income, and the name of this method is the income method. So in this particular session I'll be covering the income methods, right? So income method of estimating national income. And in this particular method there are different measures or indicators which we can see. The first indicator is GNI or gross national income, and this is also called as the GNP, gross national product. Then we have GNP versus GDP. We will compare what is the difference between this GNP and the GDP. Then we will discuss NNI or NNP, that is net national income or net national product. Then we will discuss what is the meaning of per capita income. After that we will discuss the gross national disposable income, the net national disposable income, and the government disposable income, right? And then we will also discuss the meaning of personal income. So these are the things that we are going to discuss in this particular session, right? So now first of all, income method. So till now we have covered expenditure method and the output method, right? In one of the session I told you that if you want to calculate my income, that income can be calculated either by knowing how much is the value of my production, the services that I am providing to you, or you can also judge it by calculating the amount of expenditure that I am making in my life and the amount that I am saving. These are the two different ways, right? The first one is the output method and the second one is the expenditure method. Now income method is that you can judge my income based upon the amount that I am receiving for the services that I am providing, or for the amount that I am also receiving even if I am not providing any services, right? The point is that this is the income. This is the income method. Income method means the amount that I am receiving. That is income. Very, very simple. Nothing complex, right? So how do we calculate? So this income, before we go ahead with the income, in the first session itself, we discussed the definition of the national income, the general definition or the overall definition of the national income. What is that definition? So that definition says national income of a country is the total income generated by the residents. So this is the income generated by the residents in its economic territory, in a particular period of time. That can be 1 year, that can be 1 quarter, that can be 1 month. Usually 1 year, right? So this is the definition of GDP. We have already seen this is the definition of GDP, right? GDP, which comes in the output method, right? Now in this income method, what is the difference? So in the income method we simply say national income is the total income generated by the nationals. So in income method here the focus is upon the distribution side, the distribution that I am receiving, right? And we are basically summing up the income of different factors of production. For example, we are summing up the rent, the wages, the interest, the profits and income of the self-employed people of all the individuals in the country. The indicators include gross and net national income, gross and net national disposable income. And this is mostly used in the service sector, because in the service sector, it is difficult to calculate the GDP, right? Sorry, it is difficult to calculate the national income by the output method. However, by the income method, it is very easy to calculate the national income. So, what are the indicators in the national income? The indicators are gross national income or gross national product. GNI means gross national income and GNP means gross national product. We will discuss each one of them, don't worry, right? So I am moving very slowly. Whatever I have discussed so far, I will repeat it multiple times. I will link it multiple times. I will go more deep into that. So don't worry, right? Just now be focused on this particular discussion. So gross national income or gross national product. Then we have net national income or net national product, NNI or NNP. Then we have gross national disposable income. So here the difference is disposable and net national disposable income. Then we have gross disposable income of government and gross disposable income of the household. Now we will discuss each one of them. So the first term is gross national income. Gross national income. Here, first of all, this income or product, it is same, right? We can alternatively quote it the product also. So gross national product or gross domestic product. Here you can see the only difference is this one. In the GNP we are saying national and in the domestic we are saying the domestic. Now what is the meaning of national and what is the meaning of domestic? So the domestic we have already seen, this is the economic territory, right? So the production that is happening in this economic territory, the production that is happening in this economic territory, that is GDP. So all the production that is happening in this economic territory is the GDP. If this is happening outside the economic territory, then this is not the GDP. This is not the part of GDP, right? This is very, very simple. However, in case of the national income, right, the GNP, what we see is that in the economic territory, the production done by the citizens, right, and outside the economic territory also, the production done by the citizens, both of them are included in the GNP or GNI. Now, if the production is done by non-citizens in the economic territory, it will not be part of the GNP. It will not be part of the GNP, right? And definitely outside the economic territory, any production done by the national non-citizens is very clearly it is not part of the GNP, right? So in the case of GNP, the focus is upon the production done by the citizens, whether this is done inside India or that is done outside India. In case of domestic product or GDP, the focus is upon the production that is happening within the economic territory, right? That production can be done by anyone, right? And definitely they have to be resident. We are saying the resident units. These resident units can be owned by the citizens or they can be owned by the non-citizens of the country. So this is the key difference. Now, it might look like This is the difference of the coverage. Because in the GDP we are covering the domestic area, in the GNP we are going beyond the domestic area. But friends, let me clarify it. Although it may look like the difference between the two is the difference of coverage of geographical area, but it is not that true. I am repeating my point. Although it may look like the difference between the GNP and the GDP is the difference of coverage of geographical area, but this is not true. What is true is that this is the difference of the method. In the GDP, we are focusing upon the production. We are focusing upon the production. We are focusing upon the production that is happening within the country. But in the GNP, we are focusing upon the income of the citizens, whether the income is within India or outside India. Right? So, this difference is of the method. This GDP is the production method, production measure. This GNP is the income method or income measure. This is the crucial difference. You have to very clearly understand this thing. Right? So this difference might look like the geographical difference, but this is actually the difference of the method. In the GDP, we are focusing upon the production within the country. In the GNP, we are focusing upon the income of the citizens of the country, whether inside India or outside India. This is the key difference, right? Now, let us see. So, gross national income or gross national product, they are synonymously used. How do we calculate? So, we have seen the concept. How do we calculate? So, this calculation is done by GDP-MP. We are adding in the GDP-MP or gross domestic product market price. What we are adding is the net primary income from rest of the world. This is very crucial. So, what are the crucial words? The crucial words are net, right? Net means we will see the inflow of income as well as the outflow of the income, and we will adjust both of them. So that is called net. Now, what is the meaning of primary income? So, primary income means the income that is coming from production activities, right? So, the income that is coming from the production activities. So, if the income is because of non-production activity, for example, the income that is coming from the insurance or some kind of government subsidy or provident fund, so those kind of income is not included in this income. So, that is not a primary income. So, what is included? What is the income from the production activities? The income that is earned by the factors of production. The income that is earned by the factors of production. The income that is earned by the factors of production. And what is the example? The example includes rent, wages, interest. Right? Can we say that? Yes, very well we can say that. So, the income that is earned by the factors of production, right? From rest of the world, right? So, rest of the world basically means outside the country. This basically means outside the country. So, for example, Mr. Samir. So, we have Mr. Samir. So, Mr. Samir is working in USA as an IT guy, and he is earning $2,000 on a per week basis, right? So, this $2,000 will be included in the GNP. However, it will not be included in the GDP. I hope you are very much clear. And Mr. Robert, who is earning $200 per week in India, right? He is put up in India and earning this income in India. Will that be part of the GNP? No. That will not be part of the GNP. Although that can be part of the GDP if Mr. Robert is living in India for more than 180 days. If he is a resident, then this can be income of this can be part of the GDP, but this will never be part of the GNP because Mr. Robert is not the citizen of India, right? So this is how you can identify. Now we will see. So primary income is the income resident unit earns as a consequence of production. This is very, very crucial. As a consequence of production. And who earns them? So the resident units which are owned by citizen. This is one more clarification that I can give you. It does not include what? It does not include social contributions. So social contributions like Provident Fund, ESI. So this Provident Fund, ESI, they are contributed by the employee and the employer, and both of them they contribute, and finally at the time of retirement or at the time of resignation, the employee gets some share. Current taxes. This current taxes is also not part of the income. The taxes that is being paid, that is not because of the production. So these taxes will be reduced. So finally, what is the meaning of net primary income from rest of the world? It means the income accrued to the resident units in the rest of the world, right? So this is the income of the Mr. Shamir, $2,000. Income accrued to resident units in the rest of the world minus the primary income accrued to non-resident units in the economic territory of the country. This is the income of the Mr. Robert. So in this case, the net primary income from rest of the world will be 2000 minus 200 is equal to $1,800. This is the income of the this is the net primary income from rest of the world. And friends, don't be confused by the words resident. Here the resident basically stands for the citizen only. Now let us see the difference between the national and domestic product, or GNP and GDP. We have already discussed. Now let us see much more clearly. So the production activity of the production unit located within the economic territory is the domestic product, right? So production happening within the economic territory is the GDP. I already told you. Irrespective of whether it is carried out by the resident or non-resident, right? So if the production is happening in the economic territory of India, whether this is carried by the resident unit or non-resident, this is part of the GDP of India. And basically the appropriate word will be the citizens or non-citizens, right? So whether this is the citizen or the non-citizen, that will be income of the India. National income or GNP includes the production activities of residents, or better word is citizens, irrespective of whether performed within the economic territory or outside. So the nationalists of the country, the citizens of the country, whether they are carrying the production activity inside India or outside India, all of that is part of the GNP. In other words, this is how we can see this. So GNI is the income earned by the national residents. National, this is very, very crucial. Gross domestic income or GDP is the income created within the domestic borders, right? And this GNI is calculated by adding the net factor income earned from abroad, right, minus the income generated domestically but paid to foreigners. So $200 this is, and this is $2,000, the example that we took in the previous slide. Difference between national and domestic product. National product is the domestic product plus the resident's contribution to the production outside the economic territory. Example is the $2,000 earned by Samir minus the non-resident's contribution to production inside the economic territory, that is $200 earned by Mr. Robert. So friends, I am giving you different terminology, because in the examination hall you can find different terminology, but the concept remains the same. I have picked up one example of $2,000 and $200, and I can fit that example anywhere. The language might change, but the concept will remain same. So you have to pick up the concept, right? In practical estimates, the residents' contribution outside the economic territory is called factor income received from abroad, right? What is example? Example is $2,000 of Mr. Samir. So the residents' contribution, that is the contribution of Mr. Samir outside the economic territory, is called factor income received from abroad, right? So the non-residents' contribution inside the economic territory, non-residents' contribution inside the economic territory, that is $200 of Mr. Robert, that is factor income paid to residents. Therefore, national product is equal to the domestic product plus factor income received from abroad minus the factor income paid to the residents. Here we can see much more clearly the difference. GDP versus GNP. GDP is the market value of all final goods and services produced by the factors of production located within. So what is the crucial word here? The crucial word here is located within the country or economy, right? So here the main thing is the location is within the economic territory. GNP, however, measures the market value of all final goods and services produced by the factors of production supplied by the citizens of a country. This is very, very crucial, regardless of whether this similar production takes place internally or outside, right? So what is crucial is it is supplied by the citizens. What is crucial here is it is within the country or with the economy. So this is the production measure and this is the income measure. This is the crucial difference. Next, GDP measurement. So it measures only domestic production. It also measures the production by the national, irrespective of whether this is domestic or non-domestic. What does it includes? GDP includes the production of foreigners within that country, right? So example, Mr. Robert's $200 contribution. The production of goods and services by its citizens outside the territory, right? So $2,000. So it will be part of the GNP and it will be part of the GDP. It will not be part of the GDP and it will not be part of the GNP. Excludes. What does it exclude? The production of goods and services by citizens outside the country, right? So it excludes $2,000 of Mr. Samir. GNP, what does it exclude? It excludes the production of goods and services by foreigners within that country. So the $200 production by the Mr. Robert. Widely used. Which one is widely used? So GDP is widely used to study the outlines of the domestic economy, and GNP is used to study how the residents are contributing towards the economy. So GDP is more used for measuring how much production is happening, the growth rate, etc. And GNP is basically for judging the contribution of the citizen versus the other people. Now we have seen the GNI or GNP. Now this is the concept of net national income or net national product. Net national income or net national product. So net national income is arrived after deducting the consumption of fixed capital from the gross national income, right? So this is very simple. GNI minus the depreciation. What is the meaning of consumption of fixed assets? Consumption of fixed assets is nothing but the depreciation. The concept of depreciation we have already discussed. So what is depreciation? Depreciation is the reduction in the value of the fixed asset like building, machinery, mobile phone, etc. The fall in the value of fixed asset because of the usage or the wear and tear or the efflux of time. Either it can be because it is being used or it can be happening because the time is elapsing, right? Or it can be because of the wear and tear of the item, right? And why do we reduce? Why do we reduce this depreciation from the GNP or GNI? This is reduced because this depreciation basically reflects the amount that is being used to maintain the existing assets. So the existing assets are, what is happening basically, the existing fixed assets, their value is deteriorating, right? So we must be doing some production to compensate that deterioration. So the production equal to the amount of deterioration that is basically used only for the maintenance. There is no extra production happening. So in reality, if we see this deterioration in the value of the fixed asset or consumption of fixed asset, that is depreciation, the amount equal to this we have to produce just to maintain the fixed asset in their original form. So this depreciation is not contributing to the extra production. That is why to get the real income, we have to reduce this depreciation, because this depreciation basically reflects the maintenance of the existing income, right? So NNI is equal to GNI minus the depreciation. It is known as the national income, right? So in India, when we say national income, this national income is nothing but the NNI. This national income is nothing but the NNI, net national income. This is nothing but the net national income. However, one thing is there, that this national income basically means the national income at the factor cost. This national income is at the market price, right? So what do we do to reach from market price to factor cost? Basically we reduce the net indirect taxes, right? We reduce the net indirect taxes. So the national income is equal to the net national income at factor cost, or in other words, the net national income at market price minus the net indirect taxes, right? So this is the meaning of national income. So in the economic survey, if you find this term national income, right? If you find this term national income, this will mean this thing, right? So national income is exactly this thing. When we divide this NNI at factor cost by the estimated population, we get what? We get per capita income or per citizen income, right? So what is per capita income? Per capita income is equal to NNI at factor cost divided by the estimated population. Very simple. Per capita income is net national income at factor cost divided by the estimated population, and this is basically estimated total population of the country. That is how we get the per capita or per person. Per person. There is one more term, real per capita income. What is the meaning of term real? Real basically means inflation adjusted. Right? Inflation adjusted. When this is not inflation adjusted, then this is nominal. Right? So how do we calculate real? Real per capita income is obtained after adjusting nominal per capita income for the inflation. Real per capita income is equal to nominal per capita income divided by 1 plus inflation rate. We will discuss the concept of real versus the nominal in the upcoming sessions, in the upcoming slide. So don't worry, right? Just understand that real per capita income is the inflation adjusted per capita income when we neutralize or nullify the impact of the inflation from the per capita income, then this is the real per capita income. Now, there is one observation by the UN. According to UN, an underdeveloped country is the one in which per capita real income is low when compared to the countries like USA, Canada, Australia and the Western Europe, the countries which are developed, right? So how do we determine that our country is developing country? Because our income, the real per capita income is lower than the real per capita income of the developed countries, right? So this is how we determine how our country is the developing country or underdeveloped country. Now, GDP per capita or that per capita income, this is the another terminology we use for the same thing, is the measure of a country's economic output that accounts for its number of people, and this is how we do calculate per capita real GDP is equal to real GDP upon the population. This is a small observation. Here we can see this per capita income projection of India. So currently this is at here, right? And we are slowly moving, but this level of China, the level of China that is at present in 2020, we will be able to achieve in 2036 or maybe in 2040, right? So our per capita income is very less. What is the meaning of gross national disposable income? Very crucial. What is the meaning of disposable word? Disposable means the income which can either be spent or which can either be saved. That is, this is at the disposal of the person, or this is at the discretion of the person who is having this income, right? So this is basically the income which is in the hands of the person, So this income can be different from the income the person is earning, right? It can be less than or more than that. How it can be less than or more than that? Because I am earning 1 lakh rupees, but I have to pay 10,000 rupees as the income tax. So I am earning 1 lakh rupees, but I have to pay the income tax of 10,000 rupees. So my disposable income is 90,000. However, at the same time, I get some amount from the PF or insurance. So this is my increase in the disposable income. So how much income I can spend or save? This is 95,000. So this is how this disposable income is different from the national income, right? So disposable income refers to the income that is available which can be disposed of or spent or saved, right? So two crucial words is disposed of or spent and saved. These are the two crucial words. So disposable income is equal to the income available for spending plus the income available for saving, right? So this is the usage part, how this income will be used. But what is the sourcing part? How do we calculate? Gross national disposable income measures the income available to the total economy for final consumption and gross saving, right? The same thing we have repeated here also. National disposable income is the sum of disposable income of all the resident units. Now, how do we calculate? How do we calculate the gross national disposable income, or how do we measure? So gross national disposable income, for calculating this, in the GNI, we add the net current transfers from rest of the world. Net current transfers, right? What is the meaning of current transfer? The current transfer means the income from non-production activities. The income from non-production activities. right? So what is this current transfer? Example can include the social contribution like PF, it can include the insurance part, right? And how it is different from the primary income. We also discussed one term, primary income. What is the meaning of primary income? We discussed this term when we were discussing the term of GNP. So what is the meaning of primary income? The primary income basically means the income from factors of production or income from the production activity. So this primary income and current transfer, they are completely opposite to each other. This primary income is the income from factors of production and current transfer is the income from other than the factors of production. And the example I have seen, example here it includes provident fund, insurance, and here the example includes wages, rent, profit, interest, etc. Right? So here for calculating the disposable income in the GNI, we are adding current transfer. So in the GNI, the primary income has already been included, but transfer money was not included because there we are focusing upon the income from the factors of production. Here in the disposable income, we are also adding the factors from the income from other than factors of production also. So we are considering total income, right, from rest of the world. The current transfer is a transaction without receiving back any good or service directly in return from the counterpart, right? This is the another meaning of current transfer. Example includes the pensions, the disaster relief fund, taxes, etc. This is a small data. The growth in per capita gross national disposable income in India, this growth has been declining. You can see the growth rate at present is approximately 9.8%. Here you can see the gross savings of various sectors. So this we will discuss when we discuss the concept of savings. Now here I have just given for the sake of showing it to you. Then we have one concept called personal income. Right? What is the meaning of personal income? Personal income. So personal income, friends, we have seen the disposable income, right? That disposable income, how it is different from? So disposable income is at the macro level, and in that we are just seeing that how much income can be disposed of or disposed by the economy as a whole, right? However, inside the disposable income also, there are some incomes which cannot be received by the individuals. So this personal income is at the individual level, right? So there can be some items which are part of the disposable income, right? For example, profit earned by corporate. So the profit earned by the corporate, that is part of the disposable income. However, out of this profit, there is some amount which is retained by the corporate, or the corporate do not distribute to the individuals, they keep it with themselves. So because they don't distribute to the individuals, this amount is not able to spend by the individuals or the personals. Therefore, this is reduced. So minus undistributed profits of the corporate, right? We add the transfer payments, the transfer payment which can actually be spent by the individuals, and we also add this payment for the social security, right? In other words, personal income is equal to NNPFC plus the net transfer payment. So personal income is the sum of all the income received by the entire people of the country in 1 year. The whole national income is not available for the individuals to be the country. There are some payments which are not included in the national income, but they are receiving. So we basically need to include that. And there are some payments that are not available to the individuals, so we need to reduce them. So monetary payment made to them but not included in the national income are also added to the national income. So usually the corporates do not distribute the whole profit to the shareholders. A portion of profit is kept with them to meet the future expenditure and expansion. That is called undistributed or retained profit. The example I already gave. Payment for social security provisions, for example, pension, provident fund, that is added. Transfer payment means the payment that are made not against any productive activity on the part of receiver. The example include old age pension, unemployment compensation, disaster relief payment, interest paid on the public debt, etc. Disposable personal income. Now this out of the personal income, how much can be disposed of, right? So the disposable income is basically that part of the income which can be spent or saved at the discretion of the individual, right? So out of the personal income, we basically reduce the amount of direct tax, or in the other words, the income tax. So when we reduce this income tax amount from the total amount, then we get the disposable personal income. Why do we reduce this tax amount? We reduce because this tax amount is mandatory to be paid, right? This is mandatory to be paid. They have to make the tax payment like income tax. It is mandatorily to be paid. It cannot be spent on the discretion of the individual. Oh, this data, this is not important for you. I will discuss at the time of inequality, but still you can see net national disposable income. So this is nothing but the GNDI minus depreciation. Then we have this GNDI and NNDI. So here we can see GNP market price plus net current transfer receivable from rest of the world. This is equal to GNDI. On the usage part, this is nothing but expenditure plus the savings. NNDI, we can calculate by adding in the NNP market price the net current transfer. Gross disposable income of the government. This is part of the disposable income. So gross disposable income of the government is the government final consumption expenditure. So government ka consumption plus the government ki saving, right? So government's consumption plus government saving is equal to gross disposable income of the government. Then we have gross disposable income of the household. So these, why we are discussing this separately, because in the economic agent we saw that there is household, there is this government, then we have the firms. So we are seeing this disposable income separately. This is just division of the disposable income into different categories. So GDIH is equal to GNDI minus GDIG minus gross savings of all the corporations, or this is the firms. So this households, for the household we are calculating the residuary amount. What is the meaning of residuary amount? So GDIH is equal to GNDI, gross national disposable income. So this is the total amount. Out of the total amount, we reduce the disposable income of the government. We also reduce the disposable income of the firms. So what we get? We get the disposable income of the household, right? So we are basically calculating as the residual measure using the formula. Overall, we have seen in entirety there are three methods: expenditure method, factor income or the income method, and value added method. We have discussed each one of them. You can just see and get more clarity. This is the sheet that is calculated, used for the calculation of income as per different method: income method, output method, and expenditure method. Again, this is not crucial, you can just see. And expenditure method, the formula is C plus I plus G plus NX. Income method, we calculate the total income. Evaluated method, gross output, and we reduce the value of intermediate consumption, that is the GVA. With this, I complete this session. And friends, let me tell you, this session, this particular chapter might look like very difficult for you because you have never studied the economy in so much depth. However, in the examination, the questions are of very easy level. I will be discussing the previous year questions in the upcoming sessions, so that you will find the questions are very simple. I am teaching you at the very high level, at the very deep level, so that even if the difficult questions appear in the examination, you can solve them very easily. So don't worry, right? Trust me, you will win. You will win. Trust me. Friends, this examination demands consistency, simplification, and going beyond the conventional aspect, right? I am basically trying that you don't deviate from the topic. At the same time, you get adequately deep into the topic. You get the practical dimensions of the topic, right? My focus is entirely upon the IAS examination. I will not take your attention to other examinations like RBI or the lower level examinations, because if I get to that level, that will increase your attention. That will divert your attention, and you need to study a lot for that. That is not required here. In the IAS, the syllabus is very, very specific. We can identify that based upon the previous year questions. So trust me, trust yourself, trust the God. God bless you. All the best. Thank you very much.